One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, reporting live from Ithaca, New York. This is the podcast dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason. I am your host for this show. I'm always grateful that you're listening. I'm always grateful that we're learning here together all these different aspects of investment banking, and we are going into the technicals, my friend. We're just cranking them out every single day. We cover 2 new investment banking related questions, and I'm going to continue with that for at least the next probably month to 2 months, and then we'll transition the show as we get into behavioral topics, into other topics, but we're definitely covering foundations right now in a very real way. So with that being said, mergers and acquisitions, that's the domain we're talking about right now. And today's question is this: what are the impacts of the market on an all-stock deal? What are the impacts of the market on an all-stock deal? Now, we've talked about with mergers and acquisitions in prior episodes that there's different considerations that you can have. There's different ratios or ways that you can pay for another company. There's different currencies. Your currencies are cash on hand, or you can raise debt, which is basically borrowing cash from someone else, or you can pay with stock. Now, in the case of paying with stock, let's say that one company buys another company and they issue new shares of stock in order to pay for the deal. And that's it. That's all they do. They just pay for it with stock. Imagine that this company acquires this other company for $200 million in an all-stock deal. And then the next day in the stock market, the stock crashes and the market values the company at just $100 million. What has happened? What has happened? Well, the share price would fall by an amount that corresponds to a $100 million loss in order to reflect the change in market capitalization of the buyer. So you see what's happening is that the buyer is creating shares of stock in order to purchase the seller. So let's say that the buyer has 100 shares outstanding and they double their share count. Let's say they go from 100 shares outstanding to 200 shares outstanding, and they give 100 of those shares over to the seller. So the seller's currency, what they're receiving in exchange for their giving their company over, are those shares of the buyer's stock. So if the stock market opens the next day and the buyer stock falls in market capitalization, guess what? It impacts the seller, right? Because the shares that they now own have dropped in value. Now, in the example I gave of purchasing the company for $200 million and then the market value, the company at just $100 million, that's a $100 million loss in market cap. This process overall doesn't necessarily mean that the value falls in half. That's just the way that the numbers worked out in this case. But the fundamental concept to grasp here is that the seller is putting themselves at risk here. Now, they might receive far less in value than what was paid for because of the stock market's volatility. And that's really the big risk with all stock transactions. If the seller receives their compensation in the form of stock and the stock drops, well, it's what they have in terms of value is not as much as what they thought they were going to have fundamentally. Now that stock could go up, right? You could have another scenario where the stock doubled in value after the transaction took place, and now the seller is sitting pretty. Like, hey, they just got a windfall. But it's this risk of the volatility compared with, say, the buying company bought the seller using just cash, either cash on hand or cash that they borrowed. The seller is getting that cold hard cash and doesn't really matter what the stock market does. Like, they have their cash, like they can go and do what they want with it, the owners of the company. Now the downside of that is they don't get to participate on the upside of the company that just bought them in the form of stock compensation, at least in terms of an owner of the business that sold for all cash. But you also are protected from downside volatility because you just got your money. You got your money in the bank account and you're done. So those are some of the impacts of the market in the case where you have an all stock deal. Okay? So that's what I got for you today on Investment Banking Insights. Again, my name is Alex Mason and I'm your host, and I'm so grateful that you're listening. I'm so grateful for the ratings that you share on Spotify, on Apple Podcasts, wherever you are listening to this right now, and for your messages. I appreciate all of your LinkedIn messages and even emails too. So thanks so much for those. And keep joining me next time. We're going to be continuing to go through the M&A questions as well as many more. Thank you and have a great day.